We just talked about the current rate method. Now let's look more in detail about the temporal method. So as you may recall that under the temporal method, all of the monetary items are remeasured at current rate, and all of the non-monetary items are remeasured at historic rate. And those monetary items are usually cash, marketable securities, account receivable, those kind of items, also including liabilities. And non-monetary items may include PP&E, inventory. So all of those are non-monetary items. And on the cash flow statement, operating cash flow is taken from the remeasured income statement. The remeasurement loss is added back to net income. Increasing account receivable and account payable are remeasured at the average rate, and increasing inventory is determined by the remeasurement of cost of goods sold. So what does this paragraph mean? We are going to look at this when we go through the example. So now you just need to just read through the words. If it doesn't make sense for you, that's fine. We're going to just go over all of those, go over all of the three statements again in a minute. So, and how do we calculate remeasurement gain or loss? So here, what is remeasurement gain or loss? When we go through the example, you'll have a better idea. But here, I just want to go through the concept with you first. There are two stages. The first stage, we need to calculate the balance sheet item so that the only account missing is retained earning. So we calculate everything except retained earning. And retained earning is a plug to make the balance sheet balance. And then we use this formula, ending retained earning equals to beginning retained earning minus dividend plus net income. So now we have the ending retained earning, beginning retained earning, and dividend. And then you can kind of get what the net income needs to be in order for this equation to balance. And remeasure all of the items on the income statement. So remeasurement gain or loss is whatever on the income statement that can make your income statement balance. Yeah, so maybe I shouldn't use the word balance here, but it's basically to make your income statement can add up to this net income, which is a result of this equation balance. And then as you may recall that this ending retained earning is a plug. So it's basically to make the statements like balance, to make the numbers add up. And then here, cost of goods sold on the income statement, it is not calculated by simply applying one exchange rate. It is actually calculating according to a formula, which is beginning inventory plus purchase minus cost of goods sold equals to the ending inventory. So here we want to calculate cost of goods sold. And then we need to apply the corresponding exchange rate to these three items so that we can calculate cost of goods sold, and the exchange rate we apply to the three items may be different. So that's why for cost of goods sold, we cannot just apply one exchange rate. It needs to be calculated according to this formula. So now we're going to go through, this is actually a continue from the previous example. Except that we're adding some more information here. So PP&E, so we have the acquisition date, patent acquired. And now US dollar is the functional currency. So you may still recall, so let me repeat it again here. We have local currency, we have the reporting currency and functional currency. And from local currency to functional currency, that step we use temporal method. That is called remeasurement. And then from functional currency to the firm's reporting currency, this step we use current rate method. And that step is called translation. So let's look at the example here. If you go on Island, you should be able to download a blank worksheet here. So please pull out the worksheet that have the title temporal method. So try to work on it on your own for maybe 2 or 3 minutes. Just try to, if you do not know what numbers to put in there, just try to take some guess, and then you can pause your video for now. Okay, so under the temporal method, what is happening here? If you recall from under the current rate method, we begin everything from the income statement and then statement of retained earning, and then with the last one is balance sheet. And the cumulative translation adjustment is an account on the balance sheet that make your balance sheet balance. So this was what we just covered. And however, under the temporal method, let me just go through the structure with you first. We first need to work out the balance sheet, and retained earning is a plug on the balance sheet in order to make your balance sheet balance. And then after we have the retained earning, we take it to the statement of retained earning. And on the statement of retained earning, your net income is whatever is needed to make your statement of retained earning balance. And after you get this number, you take it to your income statement. And on your income statement, remeasurement loss is something you need to calculate in order to make your income statement for the numbers to add up. So let's first look at the balance sheet. On the balance sheet, as we have mentioned, all of the monetary items are remeasured using the current rate. So what are monetary items? Those are cash, account receivable. The firm doesn't have any marketable security here, but the firm does have liability. So actually all of the liabilities, we need to apply the current rate. And everything else, inventory, PP&E, patent, those are non-monetary assets. And then the firm's equities will apply the historic rate. So the current rate at the end of the year is 0.7. Historic rate for the inventory is 0.68. And where does this number coming from? So if we go back to where those rates are, that is the average fourth quarter 2015. So the assumption here, I think it is said here in the additional information, inventory is carried at first in, first out. So the ending inventory is purchased evenly throughout the fourth quarter. So that's why the historic rate, for the historic rate, we use the fourth quarter average rate here for inventory. And then equipment is 0.61, that's when the equipment is purchased. Patent 0.62, that's when patent was purchased. And then common stock 0.6, that's when common stock was issued, including additional paid-in capital. So we just apply the rate to the local, to multiply it on the local currency, and then you are going to get your remeasurement into the US dollar. If you add this up, that will give you your total current asset of 503,000. And then you add those up, that will give you your total asset. Total liability 595,000. So now your total liability and equity should be equal to your total asset. And then we know what the total liability is. So you just need to calculate total equity, which is, and then after all of this, in your shareholders' equity part, which is this part, it doesn't add up, the numbers doesn't add up. So in order for it to balance, the the retained earning needs to be, so to balance, the retained earning needs to be 181.8 thousand. And this number, we just carry it down into the statement of retained earning. On the statement of retained earning, your dividend is applied the historic rate of 0.67. So dividend is and your beginning retained earning is 0. So on the statement of retained earning, in order for everything to balance, your net income in the year should be 282.3 thousand. And this number is carried over to your income statement. On your income statement, sales will apply the average rate. So for sales, we apply the average rate. However, for all of the balance sheet related items, including cost of goods sold, depreciation, amortization, we need to apply the related historic rate. So let's look at depreciation first. Depreciation is related to your PP&E. So we apply the historic rate, the same historic rate as what we applied on our balance sheet, which is 0.61. And then amortization is related to a patent. So we apply the same historic rate as patent, which is 0.62. Other expense, so that is kind of non-balance sheet related. We apply the average rate and income tax average rate. So one thing I want to talk about is cost of goods sold. As I said before, cost of goods sold, actually, we don't apply any specific rate here. So we need to calculate. How do we calculate cost of goods sold? So we have beginning inventory plus purchase minus cost of goods sold equals to the ending inventory, right? So here, the beginning inventory, we know under the local currency. So here is under the local currency, beginning inventory is 150,000. Purchase is 3,250,000. And ending inventory is 400,000. So we can calculate cost of goods sold here as, so this is calculated as 3 million. So but this thing is calculated. And if we are using measure it into US dollar, for the beginning inventory, it is applied the historic rate. Specifically, it is the historic rate at the beginning of the year. So which is the historic rate at the beginning of the year, which is 0.6. Yeah, I just want to double check. Yes, so it is, that is the rate at January 1st, 2015, 0.6. And purchase, we assume it is made evenly throughout the year. So we use the average rate, which is 0.65. And then ending inventory, we apply the historic rate of those ending inventory. And because the firm is using first in, first out, so all of those ending inventory are purchased during the fourth quarter of the year. So which means that we need to apply the average rate during the fourth quarter of the year, which is 0.68. And then if you apply those rates, your beginning inventory will become remeasured into 90,000 US dollars. Your purchase will be 2,112.5 thousand. And your ending inventory will be 272,000. So beginning inventory plus purchase minus your cost of goods sold should be equal to your ending inventory. And you can calculate it from here that your cost of goods sold needs to be 1,930.5 thousand. So this is how we calculate your cost of goods sold. And everything else, we just apply the rate. Gross profit is the difference between sales and cost of goods sold. And we have calculated all of the items here. And now you are going to find that if you add up those items, it doesn't give you the net income that you need, which is 282.3 thousand. So what we are doing here is we need to plug in a number, which is 47,000. And then this number is called remeasurement loss. So this is your income statement. And statement of cash flow, it's kind of similar as before, but with a little bit differences. First of all, operating activity. So this net income, so we need to carry the number from your income statement, which is 282.3 thousand. And your depreciation, amortization, because on your income statement, those items will apply the historic rate. So on your cash flow statement, we need to apply the historic rate to those items as well. So which is 0.61 and 0.62. And remeasurement loss, this number is carried from your income statement as well. So which is 47,000. And then account receivable, we use the average rate. Account payable, we use the average rate as well, which is 0.65. For increase in inventory, this needs to be calculated. So how do we calculate the increase in inventory? The increase in inventory is basically the ending inventory minus the beginning inventory. And for both of those, we apply the historic rate at the time. So ending inventory, the historic rate at the time, that is the fourth quarter. So the historic rate for the ending inventory, because all of those inventories we assume from first in, first out, they are purchased during the fourth quarter. So here the exchange rate we use is the fourth quarter exchange rate, which is 0.68. Beginning inventory, so we just apply the beginning of the year exchange rate, which is 0.6. So ending inventory, under the local currency is 400,000. We apply 0.68. That will give us 272,000. And the beginning inventory under the local currency, that's 150,000. We apply 0.6. That will give us 90,000. So the difference between these two would be the change in inventory, which is 182,000. So here inventory is 182,000, the change in inventory. This is how we calculate this number. And then for the rest of those, we just do the multiply. And then you add everything up, that will give you 474.5 thousand. Investing and financing activity, those are exactly the same as before. We apply the historic rate. And then if you add up those two, that will give you 641,000. this will give you 52,000. So your decrease in cash will be the sum of these three numbers. And then we first calculate cash at the beginning of the year and end of the year. Beginning of the year cash is the beginning of the year current rate, which is from today's standpoint, that is the historic rate at December 31st, 2014. So which is 0.6. Cash at the end of the year is our current rate, which is 0.7. And now you can see your cash flow statement doesn't balance. So in order for it to balance, the effect of exchange rate change on cash will need to be 4.5 thousand. So this is how you do the translation. Actually, it's called remeasurement under the temporal method.